Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of Alea Green. And thank you for joining us today to this webinar with the topic Prospects for European Energy Markets in the Second Half of 2022, Renewable Energies Financing and PPA. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of Alea Green, that will discuss about the evolution of European energy markets and the prospect for the second half of the year. Then, we are fortunate to have once again two speakers from Engie Spain that will talk about the financing of renewable energy projects and PPA and the main novelties in the Spanish regulation. The speakers will be Daniel Fernandez, Strategy, Regulatory Affairs and H2 Director, and Ignacio Sáenz, Head of Origination and Sales. Please use the Q&A menu to send us any questions you may have, and we will answer them after the presentations. And now, I hope you enjoyed the webinar. Oriol, please share your slides.
Good morning. Thank you, Alejandro. Good morning, everybody. As Alejandro mentioned, I will cover the first part of the webinar, talking about the evolution of the energy markets and the prospects for the coming month. We have fresh news. Just yesterday afternoon, the European Commission gave the final approval to the Iberian exceptionality. So we will talk about a little bit about that. Probably from Engie, they also will have something to say about that. So let's start. I will start just with a few words about AleaSoft and our services, in case you don't know about us. In AleaSoft, we provide forecasting services for the energy sector, covering all the European energy markets. Our forecasts go from the short term, so day ahead or hours ahead, up to forecast and long-term reports that can go up to 3 decades ahead. We forecast the demand and price for the energy markets, and also any variable that can be interesting for those markets, so renewable energy production, weather condition, fuel prices, CO2 prices, socioeconomic indexes, anything that can be useful and related to the energy markets. And not also day-ahead markets, but we are also forecasting intraday and ancillary services. The methodology that we used for forecasting is a methodology that we developed ourselves in AleaSoft. It's a methodology developed specifically for forecasting in the energy sector. It's a methodology that it's completely scientifically based, so it keeps our forecast keeps consistency over time. And we have been using this methodology for more than 22 years now, starting in the Iberian electricity market and now covering most of the energy markets in Europe. We will start with fuels and CO2 markets. I always like to start with this historical perspective of the Brent oil prices. Oil prices are a kind of a global index about the global economy. So it more or less describes how the global economy goes. And it's always interesting to see how we are now with respect to the history. And right now, as you can see, we are very close to the maximum prices that we had in the 2008, just before the financial crisis. So at the beginning, at the first half of March, we reached close to that historical high prices. And right now we are experimenting another a bull run in the oil price. If we focus in the last month, we can see how in March and April this year we had two peak prices that were, as we have seen, quite close to the historical maximums. And since then, just when we made our last webinar 3 weeks ago, I think, we were in this state where we were seeing more or less stable prices, obviously fluctuating with high volatility, but we were not seeing a clear tendency. But since then, what we are seeing right now is a clear upwards trend, and we are already at the level of the peak that we had in April and getting closer to the peak that we had in March. The forecasts are seeing, some of the agencies are seeing prices for the second half of the year around $140 per barrel. This would be at the level of the highest prices that we had back in 2008. But beyond that, it's difficult to see prices going up farther than that. So probably we are going to have a second half of the year with high oil prices. But we will see. As I said, this $140–150 per barrel, it's kind of the ceiling that it's difficult to expect prices higher than that. But we will see. We never know, because at that point the demand it's really going to start suffering from these high prices. So it's difficult to see prices higher than that. But all the forecasts point in the direction that we are going to get to that levels, at least for some months in the next two quarters. On the other hand, gas prices, what we are seeing since last month is a slightly downward trend. We are still at very high prices compared to the usual levels of 25–30 euros megawatt hour. Right now we are at the level of 80–70 euros, but with a clear downward tendency, but not very steep slope. But again, the tendency looks quite clear. Just after we had the highest prices in history in March, just at the beginning of March, just after the beginning of the war in Ukraine. From CO2 prices, the beginning of the war in Ukraine meant a huge drop in prices, mostly due to some of the speculative component that this market has. So basically fear was driving prices down, but they quickly recovered, stayed for a long time around these 80 euros per ton. In the last webinar, we were seeing what could mean the beginning of the upwards, resuming the historical upwards trend of this market, but it was kind of a failed attempt. And right now prices are again between fluctuating, but quite stable around between 80 and 90 euros per megawatt, per ton. Looking now at the electricity markets. As always, at this point, I'd usually take the time to go through some of the features of our online data platform. So we are able to see, let me switch to the platform. So we will be able to see some of the characteristics kind of in real time. So for the last weeks these are the prices for some of the most important markets, European electricity markets. These are hourly prices, so you can see how we are at the level around 200, more or less 200 euros megawatt hour, most of the markets. But we are seeing negative prices mainly during the weekends or Monday, on the early hours of Monday. If we show, this is the daily average price. We go back to let's show since the beginning of April, for instance. And you can see this is the peak prices that we had in France. Hourly prices close to 3,000 euros megawatt hour, average prices around 550. And since then, what we see is more or less the same slightly downward trend that we are seeing on gas prices. Gas prices are one of the main drivers of electricity prices, and we are seeing more or less this slightly downward trend. But again, we are still at very high levels compared to we were just a couple of years ago. As you can see, we will have a little bit, we'll talk a little bit more about this later and see how, for instance, prices in the UK are clearly lower during this time. We will relate them afterwards with lower prices in gas, in the NBP gas in UK. So we also can take a look at Spanish prices, if the platform allows me to do so. Historical prices, the history of the Spanish market is quite long. This is why it takes a little bit to load all the data. So we can compare, for instance, the gas prices in Spain and electricity prices, and see how gas prices are one of the main drivers. So if you can show, for instance, since the beginning of March, and you can see how the highest prices in history for the electricity market and for gas prices were on March 8th. And since then, this slightly downward trend in gas prices led to more or less the same trend in electricity market prices. We can look a little bit more into detail in the Spanish variables. And we can see how, for instance, let me a little load. We will see how we can also relate the behavior of the electricity market prices with the behaviors of the demand of the wind energy production, etc. As you can see, we have all the most important variables in the markets. For instance, these are the hourly prices from Spain since, for instance, the beginning of the year. We can see that the highest prices that we had in the 8th of March. Usually, and looking at the daily average, we can see, as we have just seen, this downward trend. But we can try to relate this downward peak that we are seeing, or these changes in level that we are seeing, with some of the variables of the market. For instance, with the wind production. Let me see. And for instance, I'll put them in separate axes. So, okay. And for instance, we can see how this change, so the blue line is the market prices. You can see how this increase in market prices match a decrease in the wind production. And okay, I don't know if I have time, but it's also interesting to see something like, for instance, how the wind production is related with the exchanges that we have with other markets, for instance, with the French market. And as we expect, let's put some perspective into that. Let's go back to several years, and we will show the monthly averages of all these variables. Monthly variables. Let's show, this is the Portugal exchange with Portugal. Let's show France that it's a little bit more clear. And we can see how, for instance, high wind production is related with, in this case, negative values of the interchange means imports. exports. So when there's a lot of wind production, there's a lot of exporting or a lot of exported energy. So and that makes sense because having a lot of wind production means lower prices in Spain, means more production. So we are more favorable exporting all this energy to France. Okay, so I will not spend too much time because if not, I will run out of time. So for instance, on fuel prices, we can compare, for instance, TTF gas prices. These are the prices in one of the European reference prices in the Dutch hub, and compared with MIP gas, that is the hub in Spain. And we can see how right now they are a little bit different, but if we go back just to the beginning of the year, we will see that most of the time the gas prices in Spain and in Europe are quite similar. But since the gas from Russia, from the pipelines from Russia start decreasing, the regasification capacity in Spain, that it's the European country that has more regasification plants in order to receive oil from the from tanks from the by shape. So how this regasification capacity is bringing gas prices in Spain lower than in the rest of the continent, and this is also making electricity market prices in Spain a little bit more lower prices. It's more or less the same case that in UK, that also has a lot of regasification power, so it is able to have lower gas prices and also lower electricity market prices. So I'll go back now to my original slides. So here they are, and we will go through some of the most interesting aspects. Again, we also have in our website, you can find most of the reports that we have analyzing and modelizing any aspect related with the energy sector. So this is the monthly average price for the electricity market prices for the last month, and in May, that is the last complete month that we have, we see that more or less prices stayed quite stable. So on average, there is a slight decrease, 7%. The market with highest prices has had a decrease in the price. Markets with lowest prices like Poland and Germany had a little increase. In Spain, we had more or less the same price. And as I mentioned, the case of the UK with a decrease of more than 30% in the price, it's just the exceptional case in this comparison. So as I mentioned, lower prices in the UK are related to lower gas prices there, due to, as I mentioned, the regasification power that the UK has. And as I mentioned, the fresh news that we had just yesterday afternoon, just after finishing my slides, preparing my slides, we had the confirmation, the final approval from the European Commission about the Iberian exceptionality. So in case you don't know what is called the Iberian exceptionality, government from Spanish and Portugal agreed on a mechanism in order to lower the electricity prices for the final consumers. That means lower electricity prices in the market. And the idea was to implement a mechanism to compensate the power plants that use gas, in order that for them, with respect to a gas reference price, they will be compensated for the extra cost for the final price, gas prices. So with this compensation afterwards for these power plants, the offers to the electricity markets should be lower and should be with respect to this gas reference price, meaning that lower gas prices, effective lower gas prices, would mean lower electricity market prices. And this mechanism was approved in a royal decree law that was approved on May the 14th. And since then, we were waiting for the final approval from the Commission. That was just yesterday afternoon. So finally, the mechanism will start working the next Tuesday. So these reference gas prices will be 40 euros per megawatt hour for the first 6 months, and then we'll be incrementing slowly for the next month until, at the most, it will be in place only until May. So taking this reference of 40 euros megawatt hour for the gas price with the current CO2 prices that are around 85 euros per ton, the electricity prices should be limited or should be around 120, 150 euros megawatt hour, more or less. So this is the prices that we expect if the mechanism works as expected. This is the prices that we expect for the next month in the Iberian electricity markets. So just to see how this mechanism is already having an impact on the futures market. So the day that the European Commission gave the first okay to this Iberian exceptionality was April the 26th, and just then all the futures covering maturities inside this 12-month period from June, July. At that time was June, was expected to be in place in May. From May to 2022 to May 2023, all the maturities, so all the months, all the quarters inside that period, drastically lowered their price, and all of them collapsed around 150 euros megawatt hour. And since then, they more or less changed and evolved more or less at the same level. On May the 14th, the royal decree law was published, but we were still waiting for the final approval. As the time passed, uncertainty started growing. So there were even some doubts about if they would be finally approved or not. So as you see, uncertainty increased. So the features start growing, start having different prices. But obviously, as yesterday we had the final approval, we expect that today prices will be down. And right now, I'm checking right now the prices. So the futures prices for July are yesterday, before knowing the final approval, they were around 165 euros megawatt hour. And today, right now, they are 140. So it's nearly a 20% drop in the price. And but they are still above this 110 more or less price that we expect for the prices to be just when the mechanism starts. So still some gap between the expected spot prices and the future prices right now. Looking now at what the futures markets are saying about oil, gas, and electricity. We always compare the forward curve on these markets with the forward curve that we see on our last webinar. So it was 4 weeks ago, or more or less 1 month ago. This is the forward curve for the Brent oil. And as expected, as we have seen that the spot prices are increasing more or less rapidly. So we are seeing the increase in the forward curve, mainly on the short term, and then propagating through all the horizon. At the long term, prices above, but around $70 per barrel. On gas prices, we are seeing a slightly different behavior. So as the spot prices, we have seen that they are slowly going down. the forward curve is going down, but only on the very, very short term. So basically until the winter. So the next few months, prices are going down. For the whole second part of the 2022, prices are down by 12 euros. But sorry, this is euros megawatt hour, not euros per ton. But again, after by the winters, prices are more or less at the same level that they were 4 weeks ago, and basically no changes in the rest of the horizon. On CO2 prices, as we have seen that prices were starting to grow up in our last webinar, but since then we have seen that failed attempt of resuming the upward trend. So slightly decrease in the prices in the short term, but even an increase on the prices on 2030 at the end of this forward curve. So as we are seeing in the last webinars, the forward curve is getting steeper. So prices in the curve is getting faster and faster to high values. So even prices going down in the short term, prices keep going up at the long term. And looking at the forward curve for the electricity markets, we are basically seeing slightly increases in the forward curves in the short term for Spain, also for France, that is the one that is having by large the highest prices, and basically no changes in Italy, and most important changes are in Germany of nearly that's what 10% increase, but basically no changes at the long term. Again, I always take the opportunity when showing this this graph just to remember that these are the forward curves, so are the prices being traded right now in the futures market, and they are not a good forecast of what the spot prices will be in the future. We know that into the future, as the interconnection capacity, for instance, increases, and the energy storage increases, we know that prices of all the European markets will tend to converge, will tend to go to the same level. That is something that we are not seeing in the forward curve. So again, that's a reminder: do not use forward curves from future markets as a forecast for the spot prices in the future. And just as a summary, what we are seeing right now, what we are taking into account in order to forecast. So summarizing what we have said, basically, oil prices are increasing. We expect high prices for the rest of the years. CO2 prices do not show signs of resuming the historical upward trend. So right now they are still at the level of between 80 and 90 euros per ton. Gas and electricity markets, both are highly related because gas is one of the main drivers of electricity prices. Right now showing a slightly downward trend. And the most recent news, the mechanism, well, here it's not yet updated. It says it's still awaiting. We already have the final approval from the European Commission. So we will see. Next week, we will start seeing, if the mechanism works as expected, we will start seeing a decrease by right now by 50 or 40, 50 euros per ton, just a drop in prices, and they will be at that level for at least 6 months, and then they will start increasing the gas price reference slowly, but then we expect also gas prices to start going down. So we will see. And at the longer term, well, we are we had our scenario of how the energy transition would be. We had our goals for 2030, but the current situation of the war in Ukraine, the embargoes on the commodities, gas and oil from Russia, and the intention of the European Union to accelerate this energy transition in order to have our energy independence as soon as possible. We will see how this, how much we are able to increase and to accelerate through these through these targets that we had at the mid and at the long term. And just let me finish inviting you already to our next webinar that will be July 14th, and we will be talking about hydrogen, green hydrogen, and how it is a key for the energy transition. You only see my picture, but I will not be alone. We will have an expert or several experts talking about hydrogen. So it's going to be very interesting. And as always, we will be reviewing how the energy markets are going. So thank you, Alejandro.
Thank you very much, Oriol. Very interesting as usual. And thank you, Daniel and Ignacio, for joining us again. And Daniel, when you're ready, please, you can change your slides.
Hello.
Yeah, now we can see.
Hello, Alejandro. Hello,
Hello.
Good morning. We are here, Ignacio and myself. Sorry for the quality. This is the Teams. This is the Zoom effect for the background. So thank you very much. Thank you very much to AleaSoft for the opportunity to share thoughts and markets view all together. It's always a pleasure. Maybe, Alejandro, we are starting to be a bit old-fashioned, not old-fashioned, but basically we were here, I guess, 6-7 months ago. So maybe we have to make only once a year, but we are happy to come whenever you invite us.
Of course, it's a pleasure to have you.
Thank you very much. So, well, we have prepared some slides for you today, guys, focused on regulation and PPAs. There we are sharing. Yeah, now we are going to put this in the big screen. So basically what we have prepared today is some slides dealing with the regulatory evolution of the Spanish market as of 1 year ago, June 2020 till now. What has happened? Because it seems that much more has happened than what has really happened. So basically, a quick overview of what has happened and what not has happened in the wholesale market, and how this is impacting the PPA roles in the Spanish market. And therefore, this is why I have here my fellow colleague, head of origination for Engie in Spain and sales, Nacho Sant, to drill what is the added value of the PPA today and how do we see the market today from the PPA for generators, the PPA for corporate final consumers, and the auctions. That's it. But obviously, we want to go inside the PPAs in the context of what has happened in the regulation first. Second, is the regulation jeopardizing the value of PPAs? Are PPAs squeezed in the Spanish market, yes or no? So this is the topic we would like to tackle. We are at your disposal in our email address. You have them here, LinkedIn, etc., etc. So, well, basically, obviously, we are not assessing any investment. It is just expert opinion according to what we are sharing, living, suffering the market. Agenda, I have already explained. Let's go 2 minutes on what's Engie in Spain, what are we doing, and why do we think we are entitled enough to deal with these topics. Then the overview on the regulation. Obviously, we have to talk if it is today or never, no? That we have the Iberian exception approved. So a quick overview on that. Then some reminder on PPAs that we consider it is very key in 3 minutes to have 2 or 3 pillars to properly understand PPAs, and then Nacho will go through the last part, which is the really interesting one today, about the value of the value of the PPAs. Okay, so Engie, we build today the energy system of tomorrow. We accelerate the energy system. We accelerate the energy transition for our stakeholders, our employees, our clients, our suppliers, our partners, regions, planet. Whenever we are, we make zero carbon economies a reality. For more information, engie.com, and for energy management specific services in which we are best in class, gems.engie.com. Engie in Spain is a multi-utility, has a lot of industrial capabilities at the service of many different stakeholders to foster the energy transition. What you see here is that we have just 4 businesses: electricity production with wind and solar and hydro, renewables, electricity production, CCGTs, then energy solutions, which is district heating and network assets, cogeneration assets, biomass power stations. And in this business, we have all the competences for pre-engineering, detail engineering, commissioning, etc., etc., etc. And our last very relevant business is energy management and trading, because our business of energy management is the one giving market access to all our assets and the assets of our clients and to third parties. The figures, you have it on the left leg of the slide, more than 3 billion euros of turnover in 2021, 1,700 employees, presence in all the regions, all the comunidades autónomas in Spain, and an amount of capacity installed, which is 200 mega on district heating and cooling and CHPs, and together with Eolia, which is the 1,000 mega acquisition that we started executing in November and we have completed this spring, we are now the 6th generator agent in Iberia, with after the incumbents and Acciona, which is the best in class for independence. But you see that after incumbents, we are there, and this is why we think we are really entitled to give this kind of, or participate in this kind of events. And thank you again, Alea, due to our market position. Maybe the special feature for Engie is that we put together a lot of industrial capabilities at the services of our clients and our projects. And as a very good example of this is the Goya project PPA, the Goya wind project, in which we are equity partners, we are giving engineering services, we are giving a PPA, we are also performing market access services. That's about Engie on the decarbonization. We are sustainability made for real, we are energy transition for real, and you can test this in the market with developers, lenders, etc. Regulatory evolution as of 1 year ago. Well, basically, first, it is 1 year compared now with 1 year ago. It's 1 year of extreme volatility in the market with very high spot prices. You see here power, affecting mostly domestic consumers, mostly by far. So what we have in Spain is that the historical trend is having prices, you see here in the first half of 2021, at about 50, 60, 80, 40. That's the historical average of the Spanish market is annual prices between 40 and 60 euro megawatt hour. COVID year exceptionally 34. 2021, 120. Expected 2022, 180 at the end of the year. So basically we have gas 3 times higher than the normal average, power 5 times higher than the normal average. This 5 times power directly impacts here the wholesale prices of the final price. Remember, this is the key point of this slide. The final price of power is 1/3 related to the wholesale market, another third, 40% related to network cost, regulated costs, policies to foster renewables in the country, etc., and 26% taxes. That's it. So we have the component of the wholesale market absolutely skyrocketing due to the volatility in the gas and Brent market international wise, impacting our markets. And that's it. And honestly, you see here in this upper right chart that the problem was earlier than the Ukraine crisis and so on. The problem started in last summer and more specifically in Q4 2021. You see that the level of prices of today, they were already in January and February before Ukraine crisis, and they were already in October and in December. So it is a macro problem of commodities skyrocketing. And this ends up in a political problem because the PVPC, the tariffs, the last resort tariffs in Spain, they are directly indexed to this market. And that's it. Indeed, what you see is that, why do we have the other chart here? Basically, what you see is that even with all this noise, this quarter on the Iberian exemption, intervention of the market, cap, blah, 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 at the end of the day, the forwards, they are not massively dropping. We have here, this is the day in April 26, the political approval of the cap, okay, kind of plateau descent, but the market has been recovering more or less in 2020 for 2022, which is the blue line, and basically bullish for the remaining 2023, 24, 25. Therefore, a lot of noise, a lot of turbulence, a lot of messages, but at the end of the day, what we have in Spain is obviously a lot of political pressure, a lot of media pressure due to the fact that the government needs to keep final prices, not wholesale prices, is a tool to control final prices. But you can control that also through intervening taxes, reducing taxes, also through blocking or reducing the TPA cost, regulated costs. And this is what the government has been doing as of 1 year ago till now. Reduction of taxes every quarter, more or less, VAT from 21 to 10, electricity tax from 5 to 0.5, cancellation of 7% tax reduction. We have reduction of TPAs in different tranches for different collectives, etc., etc. And then this is not enough. And now this is why in September, October, we had one cap related to potential windfall benefits for some merchant assets. And now we will have, as of next Wednesday market, next Tuesday session, we will have the Iberian cap. We will go later in the next slide through the Iberian cap to give you a flavor. But at the end of the day, the general trend, the PNIEC, the ambition of renewables, the repower Europe, the recovery after the COVID and Ukraine war, more green with more renewable, that is out of any question because the market is still stable, straightforward in the mid-run in the liquidity period, despite this year turbulences. So at the end of the day, our view is that, okay, the green ambition for Spain, it is even doubled or repowered through COVID, post-COVID, Ukraine crisis, repower Europe, etc., etc. And there are some short-term turbulences related to a political problem, which is much more on the household design and on the household and the problem to keep those prices under control at the end of the day, to keep on under control the inflation, etc., etc. But from an orthodox regulatory standalone viewpoint, the market, there is nothing extremely, there is nothing crazy in Spain. There is a lot of noise, but at the end of the day, the market will keep on working, as you see, the Iberian exception. Well, at the end of the day, the market will keep on working as of January 1st, 1997, single auction, single price, agents offering variable cost. And the only point is that CCGTs and MERT and CHPs, they will be forced to incorporate a gas price at 40 euro megawatt hour in the bidding. The cap is 40 euro megawatt hour gas that will be translated in power through the power market. That the cap is not at 40 power, it's at 40 gas to be internalized by gas generators and by CHPs. That's the Iberian cap. That's the Iberian exception. Then there is a kind of path. In November, this 40 is increased to 45, December 50, January 2026, 55, February 60. That's it. In order to make an average 50 euro megawatt hour in the full 1 year scope. That's it, the Iberian exception. The agents, this will obviously the CCGT will keep on paying the gas at 60, 70, 80 according to the contract. So this is going to be compensated through OMIE settlements. And as you know, OMIE settlement, it goes 10 days after the day of energy or the week after, 10 days after the week of energy. So therefore, there is no major cash flow problem expected related to this in terms of getting the compensation and on how, and then the compensation will be financed ex post by the demand, which has today an index price, an index product, and therefore benefiting from the market reduction. It is expected that the market will drop from the current 180, 200 euro to 120, 130, plus the internalization of the compensation. At the end of the day, maybe 140, 150. So all in all, this is why the government expects a reduction at about 50% in the final power prices. Let's see if it is 15, 18, or 12. That will be the order of magnitude. So again, at the end of the day, a merchant real generator, okay, instead of monetizing 180, 120, the price, 180, the price of today, tomorrow it will be next week 120, 130. Okay, well, fine. But in a very exceptional context, it makes sense to have exceptional measures. Maybe the debate from a regulatory orthodox viewpoint is that, do we need such a, let's say, baroque reform if the problem is the PVPC? But that, Alejandro, I left it for a future Alea webinar. And basically that's it. This is the summary on what has happened. Main message: a lot of noise, but not so many things, or at least a lot of changes related to regulated costs, taxes, etc., and a limited impact on generators. Okay, we dislike, obviously, as Engie generator, but it is understandable when it is a measure very scrutinized by the union, limited, etc. And that's it. Obviously, these uncertainties, the market for the spot market has been quite squeezed in terms of liquidity, for power, for the maturity liquidity horizon for the next quarter, next year, Cal 23, remaining of 22 and starting 2023. But for the rest, honestly, we don't see a stoppage of liquidity thinking on a structured product, thinking year +2 +3, thinking on PPAs, not at all. And at the end of the day, the Spanish bid and the Spanish plan for renewables is more dynamic than ever, and therefore PPAs are, I would say, more attractive than ever. That Nacho will come in a minute to deal on this. PPAs, just 3 messages. It is a tool that only blocks volatility, avoids volatility, mitigates volatility. You see here, OMIP, for example, there is always volatility in the spot, volatility in OMIP. You see here different quotes. These are from different, this is January, February 21. This is ending 21. So you see that there is volatility for 20, 30 euro at that time. You will see later the volatility in the last 4 or 5 months, even much 3-4 times higher. So a PPA lets the PPA buyer or the PPA seller to have a fixed price or a cap price and forget. We go to the beach and we forget the market, and that's it. PPA is a tool. You don't need to be a rocket scientist to deal with PPAs, and it is just a tool in order to not to lose money and to not forget the loss of not to lose money. That's it. It's an insurance, and it creates value if it gives comfort to a board of a generator, a board of a consumer, etc. And Nacho will go now in 30 seconds to the PPA. Here you see the volatility, tremendous historical in Spain, 2023. Until 1 year ago, it was at 50 in the forward, Cal 23. You see what has happened, no? From 50 to 154 today. But you see here also that it was at 78 late November. So 2 times the prices of 7 months ago. If you don't like, or if your business model does not allow you to live this uncertainty in the long run, 8-10 year period, 6 year period, bet for PPAs. Obviously, the fact of having public markets gives a reference, and this average gives a reference to negotiate. The fact of having regulation gives also a flavor on where to negotiate, and also it is key to have models such as Alea ones. You know very well, Alejandro Oriol, this slide. Obviously, having models is key in order to contrast, assess what is the forward market, which is an expectation of the future, and what is expected by a mathematical view, which is, let's say, not passionate about the hopes of traders, brokers, originators, etc. Obviously, PPAs are much more than prices. We always say the same message. It is about reputation between the parties. Check that your counterparties, they have track record. And there are great trading houses and streaming in Spain on this. And also, look, this is our first PPA, our index. The price is 1 page. The credit is the clauses of what happened is 20 pages, and the credit and the guarantees is basically half of the contract in terms of the word. It is key. Credit quality of the counterparties, reliability of the counterparties, and think a lot on putting in paper what can go wrong or can go in the opposite direction of any of the parties in 10 years. This is why a PPA is a complex exercise, but it's at the end of the day, it can be reached. And now, Nacho, the floor is yours to go through how PPAs create value, because I guess that nowadays people challenge, no? Whether there is value or not in PPAs, right?
Okay, sorry, I think I don't know if you can see me. Yeah, it's quite light there. Well, thank you, AleaSoft, for having me today. Always my pleasure to be with you guys. So PPAs, yeah. So it creates value or not? I think it's not such an easy question to answer. For us, definitely it creates value, but it's not the PPA itself what creates value or not. It's a matter of which is the degree of risk that a developer or that a consumer would like to assume. So we are seeing these days that in such a backwardated market that we are facing today, that for sure Oriol has explained clearly, when we can face prices in day ahead close to 200 euros, inshallah will be reduced to 150, 120 on the next few days, weeks. And you can see that in the Cal plus 6, Cal plus 7, you can find prices around 30s, 40s. So in such a backwardated market, what downstream people or corporate people is looking for, reduce their cost in energy in the short-term basis, because at the end of the day, you can get a PPA from a downstream perspective. What you are having is an average price of 60, 70, 50, whatever is the average price, depending on the sourcing that you are of taking the energy. So normally corporates are only driven by two main topics, that is price for sure, but on the other side, we are showing these days that more and more companies are more green, or they are likely they are looking for make the green transition, looking for GOs, looking for additionality on new renewable assets. So they are even willing to pay €2 on the top of the power price today. That was something crazy in the past. Nobody was looking for or was willing to pay €2 for being green. But today the reality is corporates more and more are willing to be green. On the other side, you have got developers that for sure their interest is the opposite one to the off-takers, in terms of not to greenify the planet, but to get the more profitability they can on their assets. So for them, price is also a main driver. So in one hand, we have got people looking for the more reduced prices they can get. On the other side, we have got developers trying to maximize the price of their projects. But on the top of this, they are trying to ensure or at least to handle the risk in a proper way. Yeah? So depending on the developers, you may see that people are so aggressive looking for merchant solutions. You will see on the other side there is people looking for as-produced solutions with no risk, as I'm assuming, on the PPAs. So part of the takers or midstreamers or wholesale counterparties, as Engie is try to handle the risks, to understand the risks coming from both parties, trying to align the interest between of those two. But on the top of this, to ensure the lenders that the product that they have got on their hands is a reliable product. So normally, we're living in a world with such a nice quantity of equity, but normally people is willing to do a PPA with a project finance project. So project financing depends that much on the quality of the taker. So once the price is sick, there is another quantity of points that Daniel has explained before. Yeah, so it's about the guarantees, about the payment terms. It's about the force majeure events. It's about the change in law. So there is a lot of things where you can allocate your risk. So that's why it depends on your risk assumption. A PPA could create value or not for you. So what we see, so sorry to insist, but what we see here, or at least in Engie, it's a PPA and structure to handle the risk. For us, there is nothing more risky than go merchant. So at the end of the day, what we see go merchant is a pure speculative position, and speculative things are not that bad if they are just a bubble in the sea. The problem is when the speculative market becomes the sea, and the risk management becomes a bubble, because at the end of the day, everybody looking themselves on such a speculative position could end into a situation quite dramatic, because there is another concept that Daniel explained. It's not also a matter of price, it's a matter of volatility. So let's figure out the 100% of the market will look for a merchant position for their assets. And at a given moment in time, for sure, Ukraine war will be solved, gas prices will go down, market will relax, so the prices will go down. If we, as a developers, trying to allocate our risks in such a volatile market with such a little liquidity at the same time, for sure, the result of that would be market collapsing, people not putting hedging themselves, waivers, and so on. So first thing we recommend you guys is to analyze yourselves from a risk perspective, or which is the appetite for risk that you are looking for. And depending on the appetite of the risk that you are looking for, probably PPA is not your best solution, but for sure, looking for different bricks of risk management would be a solution for you guys. So as mentioned, on one hand, we have got the people that is looking for merchant solutions, and merchant solutions today could be 200 euros price, we have seen it, but also could be negative price in a given moment in time. So capture price, it's quite important. We always look at the base load market as a price of reference, but as the time goes by, base load the unicorn gets more bigger, because there is no base load in the market today. So the liquidity on the base load, long-term base load, do not exist. If you are right now, you're a corporate and you are looking for a 10-year baseload product, for sure you're going to suffer to find it. And if you find it, you will pay very, very expensive. Not expensive, but it's a fair value. But since there is no baseload volumes in the market, that would be complicated. On the other hand, you will find some as-produced products that are assuming intermittency in risks. So potential difference in pricing in a given hour, in a given day, we will find prices of 200 euros, and in the next hour we can find prices on 5. So cannibalization of the market and intermittency risk as the time goes by increases. So depending on here, you can go for a solution on a merchant portion, for sure. 20%, 30%, 40% of merchant portion, it's something acceptable. It's a practice, market practice, and banks for sure could accept it to you. Then you can go for pure vanilla solutions, that is baseload solutions. The problem with baseload is today you are creating a massive credit risk impact. Do not forget that the prices, so if you look for a baseload product on a PV power plant, when you produce 10 hours in a day during summer times, 12 hours in a day during summer times, and you are exposed to the 24 hours price, day ahead market price today, could create a massive impact because of the difference on sun hours versus non-sun hours. So could happen, and it's happening, that with baseload products that settlements negative could happen, just in case, because the difference on the spread on the prices. And then PPAs. So PPAs, and how much do you want to fix on a PPA? So you can fix, so you can transfer the whole thing to an investment grade off-taker, for sure, but that's got a price. So it destroys value. Why? Maybe it would reduce the price, for sure. For sure will reduce the price, but for sure also a PPA will not destroy value. It's transferring price to another risk provisions. So you are paying for somebody assume risks. So at the end of the day, destroys value? No, reduces prices, but reduced price is not always equivalent to destroy value. So then you have got two different options there. It's price, or two different people that it's looking for, price seekers that it's looking for different things. So at the end of the day, then you have got another option that today is taking more and more visibility in the market. It's auctions. Always say the same, let's try to compare price with price, because an option product is not a PPA itself product as an off-taker can be, because it's government of Spain guarantee, first thing. Second thing, it's a 12 years product with an optionality to reduce the extension to 8 years. So at the end of the day, you are paying for an optionality. There is no free options here in the market. So optionalities are is what it is, and for sure have paid. So the guarantees are in such a different way. Government accepts such a different way of guarantees that the lenders or banks would accept. There is no that much complicated settlement formulas, because at the end of the day, it's a pay as produced. So there is no Reebok standable solutions. There is such a big difference in between an auction product and a PPA product that you're not to be comparable. So if somebody in the downstream side is looking to compare a downstream product or downstream PPA price with auction price, for sure they are not comparing peers with peers. So our recommendation here is go through the details, buy optionalities or not, which is the length, blah, blah, blah. So for sure are not comparable products. We are more than happy to explain you in such a dedicated sessions about the difference between those. Well, so why go for an action? But what we explained you before. So why go one side or why go other side? It's a matter of credit risk. It's a matter of different decisions. So more than happy to explain on further details if you need it. I think more or less that is not an end.
Yeah, basically that's it. As you may have, we both hope we both hope that you perceive that as Warren says, that you see that it's a kind of our idol. Without passion, you don't have energy, and without energy, there is nothing. I hope Alejandro, Oriol, and all our fellow colleagues attending, you have feel our passion for the regulatory world, for the PPA world. We think Spain is for sure the place to be, even if the market is now maybe with a lot of demand, and maybe naturally the offer or the power is a bit more, well, waiting for them short term. But I hope you have feel the passion, you have enjoyed. We have enjoyed a lot, and happy Alejandro to answer some questions, if any, or we are at your disposal.
Thank you very much, Daniel and Ignacio. Indeed, it was a great presentation. We feel it, and we are out of time, but if we can answer a question each, just to end the webinar. Uriol, I don't know if you have selected.
Yeah, I can answer one question.
Perfect.
Yeah, just to answer Daniel, just I felt your passion. Just one question rapidly. So, do you see a need to reform the marginalist electricity market model? So, and I will use Daniel's words just to. So, why is people asking to reform this market? Well, in a marginalist system, the technology that sets the price is the one that sets the price for everyone. So if we are using gas, we are using the gas price to set the electricity price. So the market is working as expected, and we think it's been working for 20 years, and I think it will be working for the next 30 years. So the electricity, the wholesale market is not the problem. As Daniel said, maybe the problem is how why did we index the final consumer prices to the wholesale prices? We think it does not make much sense. Final consumers must have a predictable and stable price, and you don't have that in the wholesale market. So final consumer prices should be tied to long-term contracts, PPAs, and we think that's the more sensible solution, instead of trying to change the wholesale market. That we think it's working as it is expected.
Agreed, and that's up to. I do say that's an European challenge, and the Union should come from the internal market. And at the end of the day, honestly, whatever market is marginalist, I always put the same example. If you have a very nice flat of 100 square meters in Paseo de Gracia, and the price there is 7,000 or 8,000 euros the square meter, what's the incentive to sell it at 4,000, for example? If there is a market consensus, right? And that's I'm still an engineer, although moving to other disciplines. But if they are economists or whatever, can perfectly explain this. Obviously, it is true that the market were designed in the 90s, maybe thinking much more on technologies with a lot of capex to be paid back instead of the technology today. Maybe solar farming is needed, fine, but what we always say is that cool down, don't kill the messenger, don't kill the market design, because at the end of the day, the principles are the same in market, and maybe what is a kind of cold reflection, putting together all the agents in proposing solutions, but for sure the marginalistic model should at some point prevail, or at least if we change, let's go for a debate. Maybe in Spain, one debate interesting is, do we need a mandatory pool or not? That's another story, but not an earthquake on the principles. Maybe we can go very quickly, Alejandro, in 1 minute through the different questions. On my side, that would say, well, instead, show the PV price correlation. Well, I would say that PV today, in 10 years, the market should have a consensus at what, 82, 85, 86% of the shape factor. Maybe this is it for wind, maybe it is at 92, 95, although that's very, very, depending on each house, depending on the moment, etc. But that's just to give a reference. Indeed, the average 10 years, 2023, 2032, meaning that if we say 88 in solar, this means 23 at 68 or whatever. Yep. No? Explain negative electricity prices. Well, honestly, in Spain, as long as there are no feed-in tariffs that justify keep on running, etc. Honestly, we don't. I think it is more an European consensus in case of balancing and so on.
No, but at the end of the day, so we are having, so for instance, so the typical week here in Spain for having zero prices is Easter time. There is no consumption or just a little consumption. A lot of wind farms producing. So grid system operator at the end of the day needs an incentive for people to stop the facilities and to support the grid. So
it is not on renewables. It is more a nuclear plant, for example, working baseload, that it may make sense to pay a bit, not to stop, in order to avoid starting back costs again, and that's it. PPA conditions could expect for negative prices. Honestly, it should be a minimum fine tuning of the price, but honestly, I don't know, Nacho, I think this is...
No, even we, in our curves, in our price curves, we are also having into account the negative prices impact. So at the end of the day, the price on the PPA that we include here is just in case negative prices, a PPA price do not move. So we can set up a cap at zero or whatever. So it's a matter of impacting the price for sure. If you want better condition of your PPA price, we can set up a cap in zero and pay the difference between those. But if not, for sure, no price movement, even in a negative price PPA, a negative day-ahead prices scenario, would be swallowed by the offtaker.
So that's a kind of exception or kind of weird behavior that has to be negotiated on the table before closing the PPA. Definitely. If I put a silly example, I have a PPA at 100 megawatt-hour. Okay, if negative prices, where to go? 80, 90, some. This is a topic to be discussed there. And then, well, the money from the variant exemption, that compensation, it will be paid by the demand that today has indexed products. Therefore, the PVPC and industrial or small enterprises that have an index contract. Indeed, Engie as retailers, we have spent for the last 2 weeks sharing a lot of information with the market operator, because the payment will be done by the demand and it will be a pass-through done by the retailers selling these indexed products. That's it. So I guess, Alejandro, we have covered the questions. There is a question: potential to collocate wind plus storage behind the meter. Well, this can be the title for a new webinar, Alejandro, but basically storage today, I think, Nacho, and you're much more close to the ground. I think it is more a kind of test of 1 meg or whatever, but what we see is that the storage typically jeopardizes the business case and so on. And honestly, I don't think, from a regulatory viewpoint, arbitration is not yet there on a massive scale, I would say.
So, but it's not a matter of PPA. So for me, storage is a matter of ancillary services.
Yeah.
So for sure, you can flatten your curve by using a storage. But for me, storage is so the key thing for storage is ancillary services and how you manage ancillary services on a long-term scenario. And maybe to talk about ancillary service plus a PPA is a backflip with double jump or whatever. So it's quite complicated to put on the same basket storage, PPA, ancillary services, but it's more on ancillary service than on PPA.
That's a complex topic, but Ricardo, what we see is that if, for example, if I have an asset of 200 mega wind, if we invest in a battery of 1 mega, we degrade the internal rate of return due to the capex of that battery, and take into account that that battery has a predefined lifetime or maybe 5,000, 6,000 cycles, then you have the uncertainty on the peak of peak arbitration that should flatten on the year. So therefore, if you see it from a, again, cold economist, M&A expert or lender or modeler, typically there is a distortion, there is a downside in the business case. Obviously, that's also strategic positioning, but then this is what Nacho is saying. The business case for a wind farm shouldn't be based only on ancillary services. No? And in the regulation, you cannot invest today in a power station of batteries, for example, because you cannot charge fully for the grid. So therefore, we think there is still maybe 2-3 years time to get maturity in order to go for those models. Alejandro, stop us, because if not, we can spend the
Yeah. Well, you cover all of the questions that we had. So yes, that ends the webinar. And thank you again, Uriol, Daniel, and Ignacio for your presentations and for the answers, and the audience for joining. So have a nice day.
Thank you.
Thank you.
Have a nice day.
Thank you. Goodbye.